So we're going to take a look at Chapter 7, Inventories. The concepts underlying inventory accounting. So manufacturing companies have three different types of inventories. Those types are raw materials, which is, let's think of pants and such. If you're making a set of jeans, you have the fabric, you have the thread, you have the buttons, the zipper, all by themselves. Those are raw materials. If you have a work in process, for instance, that's having the pocket sewn together for the jeans but not actually attached to the legs. And then finished goods are what we purchase in stores. It's what's ready for sale. So for a merchandising company, inventory consists of all goods owned and held for sale in the regular course of business. Inventory accounting applies to accrual accounting, and that's to determine the cost of the inventory sold. So think of it, every item we buy has a price, not the price we pay, but to the company that's selling it has a price that it costs them. So inventory costs include the invoice price, less any purchase discounts. So what purchase discounts are, if I buy something and it says, basically I don't buy it for 100%, I buy it less 2%, so I essentially only paid 98% for it. Freight in, so the cost what it cost me to ship it to myself, including insurance. So if I had to cover insurance, so things that come overseas, obviously you want insurance, and then any taxes and tariffs. The inventory valuation depends on the price of goods, which can vary year to year. So, I mean, think about it. We have inflation. What it costs for a big screen TV right now isn't what it used to cost. And it's necessary to make an assumption about the order in which items have been sold. So you have a car lot, and it's pretty easy to track when that specific car got in, right? Oh, I received this car 10 days ago. I sold it 2 days ago. You know, each car has a VIN number. Do each pair of jeans have a VIN number? No. Whatever you have there, you have there. So think about when I'm looking at inventory costs and such and how to price them, I think about fruit and vegetables. No one wants the fruit or the vegetables that have been sitting there for 7 days. They want what just came in. So keep that in your mind as we're going through items and costing. So the good flow refers to the actual physical measurement of the goods in a company, and the cost flow associates with their assumed flow and the cost of items specifically. So merchandise in transit. So think about this. In the world we live in, things are shipped, things are received. So outgoing goods with a freight on board destination are included in the seller's merchandise, whereas those items shipped FOB shipping point are not. Incoming goods shipped FOB shipping point are included in the buyer's merchandise inventory, but not. So why does that matter? Well, remember, when we look at our balance sheet and such, it's all as of a certain date. So you still, even though you might not have the goods on hand, if you've ordered them, the way it was shipped means it could be your inventory. And think about it. I mean, if things are going railroad, it matters, because it might not be yours. For instance, if that train gets derailed, who's at a loss? Who calls their insurance company for that? That all comes into play in these shipping determinations. Plus, also in my job, I look at it quite often for looking at inventory. So goods to which a company does not hold the title should not be included in their physical inventory, and these include goods that are not yet delivered to the buyer, and goods that are held on consignment. So consignment's pretty interesting. Merchandise that is the owner places on the premises of another company, with the understanding that payment is expected only when the merchandise is sold, and that unsold items may be returned. So certain things, have you guys ever seen someone stocking a grocery store? For instance, the other day I saw Pepperidge Farm stocking it. That doesn't mean that Walmart has purchased all of those Pepperidge Farms items. What happens is they put it on consignment, and the items that sell they get, a percentage, and so does Walmart. But also, if they say things expire and don't move, they have to take those back. They aren't a sale for that company. So one of the interesting items is, how do we price items? What's a realistic price for this? And that's where the market value comes in. So if market value of the inventory falls below the cost because of physical deterioration, obsolescence, decline in the price, a loss has incurred. So think about computers. Computers change all the time. If you have a computer that was made 4 years ago, is that worth the $600 it took you to make it? No. No one's buying the computer you made years ago for $600. So the loss is recognized by writing the inventory down to what you could sell it for, or what you could currently replace it for. When the replacement cost of inventory falls below its historical cost, that requires inventory to be written down also. So basically, you can't hold it on your books. Just because it took you $600 to make it doesn't mean it's a realistic cost on your books anymore. So each year or each reporting period, you need to look at that and verify. The inventory cost under a periodic inventory system, the value is assigned to the ending inventory, and it results of two measures: quantity and cost. So a periodic inventory system is it's used as things go out, as things go in, as things go out. So periodic means a period of time. Could be a month, could be days, could be a week, could be a year. Most of the time, it's not a year, depending on what type of business you have. But the cost is determined by using one of the following methods: specific identification. So specific identification is really used when you have things like cars. They have VIN numbers. You have paperwork detailing each car. That's pretty easy. Specific identification is not used in valuing a pair of jeans, or a little rivet, or fasteners or bolts and such. Then you have average cost, which basically takes an average of what all the items you have on hand, and it takes a look at the total cost of goods available for sale divided by the total number of units available for sale. And then you have first in, first out method, which we'll call FIFO, and you have last in, first out method, which we'll call LIFO. The choice of the method depends on the nature of the business, the financial effects, and the cost of implementing the system. Some are a lot more expensive to implement. So specific identification identifies the cost of each specific item. It can only be used when it's possible to identify the units, such as cars, as I noted. It may appear logical, but most companies do not use it because it's impractical, if not impossible, to track a lot of their purchases and sales of individual items. When a company deals in items that are identical but bought at different prices, deciding which price sold becomes arbitrary. So you buy all the bananas at a certain price, you buy half of them at $4, you bought half of them at $4.50, which price do you sell? You can't really identify items like that. So the average cost is also called the weighted average method, and that's very simple to calculate, but not very accurate most of the time. So the inventory is priced at the average cost of the goods available for sale. So you know exactly what it cost you. To build all of these items, it cost me $1 million, and you have 100,000 items. Therefore, you know the average cost. You take the total cost of goods available for sale divided by the total units. So the average cost method tends to level out the effects of cost increase and decrease because it just takes a floating average, essentially. Ending inventory is influenced by all the prices paid during the year and the cost of the beginning inventory. First in, first out method assumes that the cost of the first items acquired should be assigned to the first item sold. So what that means is the oldest produce, essentially, if you're thinking of produce in this scenario, the oldest produce would be assumed to be sold first. So you know how whenever you go in a grocery store, you see them rotating the fruit and such. That's kind of what they do with the prices to value inventory. The oldest ones go out first. So first in the basket, that cost goes out with the first item sold. So cost of goods sold on hand at the end of a period are assumed to be that from the most recent purchases, and the cost assigned to those goods that have been sold are assumed to be from the earliest purchases. So the LIFO method values the ending inventory at the most recent cost and includes earlier costs and cost of goods sold. What does that matter? Well, when you have inflation, that means that the value of your ending inventory is higher because you're paying higher prices at the end of the period. Last in, first out is the complete opposite of that method. So the costing of inventory assumes that cost of the last items purchased should be assigned to the first item sold, and that the cost of the ending inventory should reflect the cost of goods purchased earliest. The effect of LIFO is that the inventory value is at the earliest prices, and your cost of goods sold is at your most recent prices. So when taking a look at LIFO, if prices are going up, what happens is LIFO charges the most recent prices to your cost of goods sold, which basically means you have a lower profit. Now everyone sitting there says, no, profit is good. Profit is good, but it comes with a price of higher taxes. So when you take a look at that and everything, a lot of people, for tax purposes, like to use LIFO, but what happened in generally accepted accounting principles is they said, look, we get it, you want to lower your taxes, but you can't have your cake and eat it too. So if you are going to use the LIFO method, you have to use it for book purposes, for your financial statements, and you have to use it for tax purposes. So when we take a look at FIFO, in a period of rising costs, which charge the earliest prices to the cost of goods sold, FIFO basically creates a larger net income and a higher inventory value on their balance sheet. The gross margin under the average cost method, you guessed it, falls right in between LIFO and FIFO. So a lot of people think, oh, average cost is easy for me to calculate. It falls in between. I'm gonna be conservative. So, as I said, the IRS governs how inventories could be valued for tax purposes. They give a company a wide choice. They can use specific, average, FIFO, or LIFO. But during a period of rising costs, a company using LIFO will pay higher tax rates if they let their inventory at year-end fall below the beginning level. So what happens with LIFO is, say I buy a product and I start making the product in 1990, I can use that price, say, for instance, a piece of wood. Say I first start buying this piece of wood in 1990 and it costs 30 cents. I can then, in 2015, say that I have still held on to that piece of lumber from 1990 and it costs 30 cents. If I have an issue and basically I use up all of my product or a lot of what I have, you can have what's called the LIFO liquidation, and it basically means the units sold exceed the units purchased for the period. So I basically went deep into my inventory, and that will cause me to have a huge tax implication from that. So under the perpetual inventory system, inventory is updated as purchases and sales take place. So think of Old Navy. When you scan, or Walmart, or wherever, most retail shops, when they scan it, it goes out of inventory. Most manufacturing and businesses don't have, besides retail, don't have a scan function. So when they're taking stuff off the shelves and building different pieces and such, the inventory system might not be updated as regularly. So the cost of goods sold is accumulated in the perpetual inventory as sales are made and costs are transferred from the inventory system to the cost of goods sold account. The cost of ending inventory is the balance in the inventory account. Goods are valued in the same methods. It's just a matter of how often it is updated. For a specific identification method, detailed records for purchases and sales are maintained under the perpetual system, and they facilitate the use. AKA, when the car comes in, it has a specific invoice, it has papers and such. Under the Perpetual system, the average cost is computed after every purchase or a series of purchases, depending on how items are sold. FIFO, when the costing of inventory with the FIFO or LIFO, it is necessary to keep track of the components of inventory because as sales are made, specific costs can be assigned to the proper order. So valuing inventory by estimation. When you take a look, the most commonly used methods for estimating the value of inventory are there's the retail method, which estimates the cost of ending inventory by using a ratio of cost to retail price. So I basically mark up my product 20%. So if you know what everything would sell for, then you could take a look at that. And then the gross profit method, which assumes the ratio of a gross profit for the product remain relatively stable for the year. You can calculate that. Obviously, when using the word estimation, it means it's not as accurate as other methods. So the gross profit method is used in place of the retail method when records of retail prices of the beginning inventory and purchases are not available. So basically, when you can't identify different things, you don't know what your beginning inventory was and your purchases and such for the prices. The method is acceptable for estimating the cost of inventory for insurance claims and for interim reports, but not acceptable for valuing in financial statements. Gross profit method involves 3 steps and such, but again, most of the time it's really only used for inventory claims. So a lot of times when your building burns down, so does your inventory records and such, if you're keeping on paper. So now let's turn the tables a little and let's take a look at a few ratios in inventory. So there's the inventory turnover. Remember in Accounting 1 we looked at some ratios and such. So the inventory turnover is the average number of times a company sells an amount equal to its average level of inventory. So basically, how long does it take me to take a product from the jeans, the fabric, the thread and such to fully sold to a customer? How long does that take on average? Then there's also days inventory on hand. So it's the average number of days it takes a company to sell an amount equal to its average inventory. So what that means is if I stop producing today, how many days can I go with my sales? So, certain things like around holidays, they need to know that if they shut down for Christmas, they still have enough product to sell for the next few days after Christmas and such. So those ratios help look. And it also helps you look and see if you're holding on to too much inventory. If you have 365 days of inventory on hand, clearly you're overproducing and your product's not going anywhere most of the time. To reduce levels of inventory, many merchandisers and manufacturers use the supply chain management in conjunction with just-in-time operating environment. So supply chain management is a company uses the internet to order and track goods that it needs immediately. So it's basically you have to work very closely with your suppliers and know, okay, I ordered this on Tuesday, I'll get it by Thursday, I can put it in my product on Friday, and it can go out. And different things. Or, okay, I need to complete this order in 2 weeks, it's shipping to me, it'll be here on Wednesday, and I can do it. Now, a just-in-time environment is one where the goods arrive just in time as they are needed. So, for instance, I am due to start a job on Monday. Those parts literally arrive Monday morning. I complete it and get it out. It basically says, okay, you don't need any inventory on hand to do it. Now, how many of you remember Dell computers when they weren't sold in stores? So Dell actually used to do the just-in-time. You would have to call them up and physically order their product or go online and order their product. They wouldn't have it just sitting there. They would actually have to make the computer that you ordered to just-in-time operating environment. Essentially they still do that because they will hand make a computer for you. In fact, that you can ask for your specific memory and everything. But they also found that they were losing the market because they weren't in stores. So now you can go to Walmart, you can go to Target, you can go to Best Buy, and you can buy a Dell computer. But those are all ways of handling how your inventory and how much inventory you have on the shelves. Now, inventory is clearly very susceptible to fraud. But it's also, and I'm talking physical fraud. Like you can, if someone's shoplifting, they're stealing inventory. But it's also susceptible to financial reporting fraud because as we talked about already in the chapter, there's different ways of valuing inventory. So if I decide to go from FIFO to average cost method, I can come up with any specific reason that I wanted to do it and okay it because they're all allowed methods. But really, what I could be doing is overstating or understating my inventory. And you can also do that by adjusting your year-end purchases, your sale transactions. So if I have a big sale on January 3rd, 2016, I might want to move that to December 31st so that my sales look bigger in my 2015 year. So a misstatement can also occur because of deliberate manipulation of operating results, motivated by a desire to enhance market perception of the company, obtain bank financing, or achieve compensation. At the end of every quarter, all of the publicly traded companies come out with their earnings statements, and everyone judges them on, okay, they predicted they were going to earn 10%. This quarter, they earned 12%. Wonderful. Oh, they earned 8%. And everyone, their stock price drops and such. So inventory is a way to help companies control that and take a look at different things. So in my next video, we're going to take a look at some in-class assignments and different things and calculating the items. I'd like to note the page 268 through page 270 help you in looking at the methods and how to calculate them. Also in the book, page 274 to 276 shows you different ways of valuing it. So remember, our inventory is always moving. As you go in a store, it's always moving. For those online shoppers these days, when you look and say, okay, pick up in store or purchase it's already in my store and such, that inventory is moving. Someone has to know that, when I walked up to the register and purchased it, it's no longer available in store. So we're going to